Hey everybody, welcome back to my channel. In this video, I'm going to give you some technical analysis of the major stock indices, the Russell 2000, the Dow Jones, the S&P, the Wilshire, and the NASDAQ to sort of give you a gauge of where we stand in our bull market cycle for the stock market. I do think that, we're seeing the end of this cycle, and I'm trying to help you give you a gauge of where we're going to peak based off of these indices. Now, if you've listened to me in my earlier videos, I have been saying that the potential peak could be about mid-August due to the fact that the CPI and other producer price inflation reports and the export-import price inflation reports would be coming out at that time, and they would be pointing to higher and higher inflation. And because they would be pointing to higher and higher inflation, they would spook investors and start, causing the migration out of the stock market, out of the bond markets, and into more safe haven assets, the flight to real values, okay? So there would be a flight to more consumer goods, which could stimulate even more CPI inflation, definitely a flight to gold and silver, other precious metals, because of I think that they are extremely undervalued compared to traditional investments like stocks and bonds, commodities, and then of course real estate. So without further ado, let's get on with the video. So the first chart I'm showing you here is the Russell 2000. And I want you to take note here that for basically the past 4 months, so from March, April, May, and then June, and then of course, now in July, the Russell 2000 has peaked already and is actually on a slight downward trend, okay? Now, this is not necessarily indicative of a bear market for the entire stock market. Why? Well, for one is that the Russell 2000 comprises the smaller end of the stock market. These are small end companies with low market capitalizations. These are the ones that are most susceptible to business cycle trends. And unless if you're seeing like a sudden reversal, when you're seeing more of a gradual change where the business cycle and the relevant sentiment to stocks and business starts to gradually become more negative, the Russell 2000 will be the first to actually feel those effects and of course sell off as investors dump smaller cap, riskier stocks that are unstable, whose earnings potential are not as strong as their bigger cap counterparts, and they flock into bigger cap stocks as well as bonds and safe havens. And I think that's what we're seeing right now, because we've been seeing ever since bond interest rates peaked, when they peaked around April, right? Late March, early April, bond interest rates have started to drop as investors are fleeing riskier assets and trying to find safe havens, okay? And to them, safe havens are bonds because the Fed is actually buying those bonds, or at least reducing the supply of total bonds available, which is driving down rates and yields, driving up prices and making them lucrative. They also believe that this is going to be a temporary issue of what they're seeing in the economy. So there's the COVID pandemic shutdowns, there's the botched reopenings because of the pandemic spread, there's the threat of rising inflation and the assurances by all officials that this is going to be a temporary issue and it will soon resolve. So investors are parking their money into the high end of the stock market, large capitalization stocks, and then bonds to wait that out, okay? So the Russell 2000 is pointing slightly negative, but to me this is not indicative that the stock market is about to go into a bear market yet. I was more waiting to see a more southerly turn in these prices, particularly a break below the floor here of around 2100, and we haven't been seeing that yet. And of course, we kind of got tested that in middle to late July after the inflation numbers started coming out once again, but it did not break that actual floor. And because it did not break that floor and sort of bounce back in this channel, it tells me that we're not ready to see a bear market yet, and that my prognostications of a bear market in mid-August, may actually be too bearish of a call, okay? Now, to further add to this, let's look at the Dow Jones. So, as I said before, investors are flocking into the higher end of the stock market. So, it stands to reason that the Dow Jones and the S&P 500 will be shored up here, okay? So, here's the upward trend, right? You can see this huge upward trend in price movement, especially among the ceiling price for the Dow Jones. Now, your floor price had been risen at a pretty consistent, constant rate, but your ceiling price absolutely exploded here in between mid-March and mid-April, and then it started to slow. You can see with each ceiling peak, the rate of growth started to diminish, okay? And this was something that I have been wanting to see, and this makes sense because these are inflationary turns. Now, the reason why this is hitting the Dow Jones so much is because your Dow Jones is comprised mostly of industrial stocks, okay? So your manufacturing industries are very interest rate sensitive, okay? They have to depend upon borrowing money to finance large capital expenditures to complete their projects so that they can get paid. Any kind of instability in the economy, whether it's pandemic related, which of course will hit them on the back end, or if it's inflation related, which will hit them on the front end, is going to constrain and hurt those manufacturing industries. And in this case, although it's not the interest rates that's killing them, it's the high commodity prices that manufacturers are having to face as they are getting hit with higher input costs, cutting into their revenues and margins. So that's causing this huge slowdown in the Dow Jones. But again, despite rising inflationary trends, take a look at this. The Dow Jones has remained pretty resilient, and that tightening floor channel that we're seeing here is suggestive that if we see a strong turn to the downward trend, this is going to force the Dow Jones upward again. So, this is still bullish for the Dow Jones. It's certainly less bearish than it is for the Russell 2000. Now, when we go back to the Russell, I do expect that we should see more of a downward trend as time goes on, but whether it's going to test this floor or not remains to be seen. My guess is yes, but we'll see if it breaks below that. If it breaks below that, the Russell 2000 will probably officially go into a bear market, and then it's only a matter of time before the larger indices stock markets go into there. But for right now, the Dow Jones is not confirming that we're entering into a bear market yet. Now, that being said, with a tightening floor comes a dangerous scenario. What happens if the inflation numbers come out and they're bad, they're worse than what investors fear? Could that drive the Dow, southward and, drive its price below the floor and shatter the floor? Yes, it can. It can absolutely, and then the testing point to confirm that bear market will be the 34,000 point mark. So if the Dow Jones falls below this 34,000 point mark, that would definitely signal a reversal in the trends of the Dow Jones and probably signal that it would likely enter a bear market. But that remains to be seen at this point. The S&P is much more bullish. So the S&P is showing consistent rising trends. Now, like the Dow Jones, it's showing a weakening in the growth, right? And this is about the late April area, May area, as we were getting hit with rising price inflation. But this weakening is very slight on this S&P front here. The S&P is still being pushed up, and I'm surprised by this, but it may be because the S&P 500 is containing a larger swath, a larger batch of large capitalization stocks, okay? So it's not just channeled into manufacturing, industrials, and construction and things like that. It's actually, giving you a more indicative run of the entire stock market on the large capitalization end. And so that this is signaling that investors are parking their money into these large cap, safe blue chip stocks to wait out the economic storm, and that may be why it's being shored up. So in my opinion, if we were to see a bear market commence, it'll start with the Russell 2000, then facilitate to the Dow Jones, then into the S&P. Now, shockingly, above all, the Wilshire 5000, which is the largest comprehensive stock market index, so it's like the S&P 500, but it's not just on the large end, it's also on the small end. It contains the largest batch of stocks that there is, and many people just use it, and myself included, as just a great way to gauge the entire stock market capitalization. It's also pushing upward, okay? So that's a real mystery, and it's pushing upward at a sharper rate than even the S&P 500, which stands against my narrative. My narrative has been saying that we're flocking into large cap stocks, yet the Wilshire 5000, which comprises both small caps and large caps, should not be seeing the returns quite as much as what we're seeing in the S&P, yet we're seeing greater returns in the Wilshire 5000. The mystery there, the mystery question there is why? Well, I think it's because the Wilshire 5000 has a lot of tech stocks into it, like the NASDAQ. Your NASDAQ is shockingly the most bullish trend, and that's an interesting turn on the NASDAQ because your NASDAQ should be the most interest rate sensitive. But when you realize that the NASDAQ is the most interest rate sensitive, taking out this huge drop in NASDAQ price from mid-April to May from the inflation numbers, it starts to make sense because this was the time when the 10-year interest rate started to fall. So when interest rates started to tighten and shorten, the NASDAQ, which is comprised of technology stocks primarily, and they are the most interest rate sensitive of any stock market indice, stood the most to benefit from lower interest rates. And these lower interest rates that we're seeing from investors flocking to safe havens has been pushing this NASDAQ into a huge bull market run. So in my opinion, this is going to be the last of the indices to actually turn southward in a bear market. Now, with all this being said, when do I think that this is going to commence? Well, the Russell 2000, as I mentioned before in an earlier vid, and I'll post that in the link, is the key. When that Russell 2000 starts to confirm a bear market, that's when we should start looking for a chain reaction. Once the Russell 2000 confirms, then we look for a confirmation in the Dow Jones. Once the Dow Jones confirms, we go to the S&P. Once the S&P confirms, we go to the Wilshire. Once the Wilshire confirms, we go to the NASDAQ. But based upon these strong growth runs, and I'm going to use the Wilshire as the entire stock market index, based upon this strong growth market runs, I really don't see the inflation numbers, unless if they are really, really bad in mid-August, turning this southward and pushing this into a bear market just yet. I do see a bear market coming, but this actually could take months to develop, because I do think what I would expect is that when August's numbers to come out, that we start seeing a weakening growth trend in the Wilshire 5000. So this angle starts to flatten a little bit. It starts to approach more on the 90-degree spectrum here, and we start to see this angle just flatline a little bit, turn more horizontal as ceilings are no longer being tested as much and floors are being tested more. But nevertheless, I don't really see the floor being shattered or broken into in a bear market commencing in the broad aggregate stock market. Perhaps in the Russell 2000, but not in the Wilshire 5000. If I were to guess right now, I would say that the commencement will start around September, and there's a multitude of reasons why. The biggest one is, of course, the inflation numbers. One of the big things about the inflation numbers, and I have this on my projections for the CPI, is that I expect, of course, this is assuming my projections are accurate, which they may not be, I expect the year-over-year inflation rate to reach 6% in mid-September from August's numbers. That's a psychological effect, okay? So investors are going to be eye-popping to see 6%. We have not seen a year-over-year inflation rate of 6% in 30 years, okay? Think about that. Think about that. Really, 40 years. We have not seen a year-over-year inflation rate for over 30 years. Once that number hits, no matter what, psychologically that's going to trigger investors to say, wow, this is real. Now, if that were the only thing alone that I would be seeing, I wouldn't say that would confirm a bear market. But you have to remember, coming up in September, October, and November is going to be the debt ceiling debate, okay? During the debt ceiling scare of 2011, stocks turned southward briefly as investors got spooked that the United States would no longer be able to honor its debt obligations. So here, when we look at the debt ceiling debate over the summer in 2011, you can see here how the stock market turned southward around here, and it corrected. It actually had a pretty strong correction. It was over a 10% correction in just about a month over here because of that debt ceiling scare. I expect that us to have a sort of repeat of that in the coming months, and it could potentially start in mid-September combined with rising inflation. Now, what about the interest rate? Shouldn't the interest rate start spiking up because of the increased risk? No, because once again, investors are pricing in that this is all temporary. Even if the inflation numbers start to hit, they're still going to be scared because of the debt ceiling, and so they're going to flock into temporary safe havens before they move their money back into stocks. Putting it simply, investors it has not yet entered their minds to seek permanent safe haven assets like precious metals. They're not going to do it yet. That's going to be the last resort, not the first. Now, on the plus side, for those of us who are bullish on precious metals, that gives us time to buy. We're buying this stuff at discount price. Think about it like this. Your house is on fire and somebody is offering you fire insurance. Think about that. Let that sink in. You're paying these low premiums relatively speaking, low prices, for things that are going to insure you from a disaster that you know it's going to happen. The investors here are stupid. This is not a black swan event. This is a white swan event. This is very common. The only reason why it seems uncommon to them is because it hasn't happened in 40 years. So the mindset is that if it hasn't happened in 40 years, therefore it's not going to happen in the next 10 is prevalent in their minds. Only when it gets drilled down into their head over and over and over again with month after month after month of repeatedly high, groundbreaking inflation numbers will it slowly sink into their heads that this is real, that the Fed has been lying to them or has at least been misinformed. That being said, now is the time for precious metals. You can also make money in the stock market with this for at least the next month and a half or so. Yes, especially in the NASDAQ. It's looking very bullish. So I do expect stocks on the four major indices, your Dow Jones, your S&P, your Wilshire, and your NASDAQ, particularly the last two, to push upward. Only the Russell 2000, the smaller cap stocks, do I say that we should stay away from. Okay? So, for what it's worth, digest that information, chew on that, and again, hopefully this provides you a little bit of clarity and insight to make the type of decisions that you need to preserve your wealth and capital. Thank you guys for watching this video. If you like my content, make sure you just click like on the video, show me some support, comment on the video, hit that subscribe button, hit the notification bell. I really do appreciate it, guys. I make these videos for you more than anything else, just to inform you. So again, thanks for watching. And probably, I don't know when the next trend of data that I'm going to be looking for out is. I'll have to check the economic calendar schedule, but perhaps that will shed some light onto what's going to happen for third quarter. I know that the GDP Now forecast have already come out, so I'll be digesting that. But right now, those preliminary data is more speculation at this point. Anyway, I'm sure I'll produce a video either later on this week or this weekend when new data comes out. So once again, I thank you for watching, and until next time, I'll talk to you later.